I want to quickly begin this video by asking who here has ever made a mistake when it comes to their investing career. I'm pretty sure it's safe to say that most people watching this have made some inopportune trades in the past. And that's completely fine. We all make mistakes. Investing, I've learned, is deceptively hard to do right. You can read all the books you want on the topic, follow and gain inspiration from the legends like Warren Buffett, and there's still going to be lessons that you have to just learn the hard way. And that's okay, there's nothing wrong with making mistakes. The key here is to identify mistakes, learn from them, and become a better investor as you go. And that's why in today's video, I want to cover two, I guess you can call them areas of confusion that I see pretty often in the investing world. The first one is the whole debate of growth versus value investing. Which one is better? As you would imagine, it's more complicated than just choosing a line that goes up and to the right more than the other ones. And then we're going to follow this up with the dividend yield theory. This is something that personally has confused and misled me for quite a while. This has to do with the dividend growth rate, the true effect of that long term on the investment, things like the yield on cost. So hopefully today I can bring some clarification to all of those metrics and what they really mean. But we're going to begin with the classic growth versus value debate. I see this question being asked and answered on a daily basis on Reddit, and it goes something like this. People post a chart like the following: a value versus growth investment side by side, and they often come to the conclusion that growth is above that of value, and thus long term growth is always mathematically the better investment. But the data is way more nuanced than that. So beginning with this next chart, this might be a little bit surprising to you. So this is the long term relative excess returns between value and growth investing. And you're going to immediately notice this cyclical back and forth of value outperforming followed by growth outperforming and back again. And I mean, just looking at this, it seems to be a relatively even 50-50 split going all the way back to 1979. There is, however, one major anomaly on this chart, and that is the recent history, where growth had this unusual period of outperformance relative to value. And that's potentially one of the reasons why when you look at the recent history in charts like this, growth is doing so much better than value. So that's point one I wanted to point out. Growth doesn't always outperform value. It's a very cyclical relationship between the two. But then the other point here that has to be taken into consideration is the level of volatility each style of investing has and the effects on the investor. It's pretty evident in these charts that growth has a much higher level of volatility in comparison to value. In fact, having more volatility is one of the things that makes a growth stock different than a value stock. But just to highlight this difference even more, I made a hypothetical chart here between stock A and stock B. Stock B represents a hypothetical growth investment, stock A value, and we can see here that at the end, the growth stock did have significant outperformance over the value stock. You can say maybe even as much as 50%. So most people see that stock B has alpha over stock A, and thus they buy stock B thinking it's the better investment. But the thing that most people don't realize is this outperformance has a price that you pay in order to achieve it. So often we see growth and value stocks move in the same general direction, but the growth stock has a lot more of these bubbles that form followed by extreme pain. And some of these periods of pain can last for years on end, represented by this hypothetical chart here. And these are periods of time that if you bought investment B simply because it was going up in price and doing better than investment A, you're really going to have a difficult time holding on to it. This is known as the trough of despair. You're going to be questioning why you bought this investment to begin with. The other boring, low volatility names like stock A are going to be outperforming you. But often, if you have high conviction, a strong stomach, eventually you will have to contend with volatility every step of the way, but eventually you can achieve this level of outperformance, but the road there is just way more difficult, and again, that's the price you pay for this extra return. And not to mention, market timing is much more impactful with these high volatility names. You often have to buy these growth stocks while they're in a period of underperformance, which is the exact opposite of when most people buy them. And I think that's easily a leading indicator of why the average investor has such poor returns over time, even compared against basic benchmarks like the S&P 500. Okay, so that's mistake number one. The next topic here is all about the dividend yield theory. And in short, this theory essentially says that for especially blue chip dividend paying stocks, dividend yields tend to revert to the mean over time. And that's what this chart right here illustrates. It is the historical dividend yield of an asset. There's times that it goes up, down, but overall it tends to revert back to the same level. And that can be very confusing because dividend growth is a major reason why people invest in assets like SCHD. They come to Seeking Alpha, they see that the dividend growth rate is in the double digits, and that leads them to believe that their dividend yield in the future is going to be 5, 6, 7, 8%. But even with SCHD, as we look back on the historical dividend yield, it is shockingly range bound. The dividends do grow over time from, in this case, 26 cents per share to a whopping 66 cents per share. And according to this theory, that is because of the close relationship between the earnings growth of a company and the amount they pay out in dividends. And you guys know that there is an inverse relationship between price and dividend yield. So when they move in the same direction together, the yield remains the same. The only time the yield of an asset changes is when one of these ratios change. As an example of this, during March of 2020, when the valuations of assets went way down, the dividend yield of SCHD spiked. And then we essentially had the opposite during the bull market of 2021. The prices, the P ratios expanded well faster than the earnings growth, and thus the yield came way down. And that's why we have these fluctuations in the yield over time. But the argument here is that long term, this averages out and reverts back to the mean. To be sustainable, the earnings and the dividend have to grow at the same pace. So that's just a little warning to you guys. If you ever try to use a dividend growth calculator like this, you tend to see two separate values here for the expected dividend growth rate and the share price appreciation rate. And again, over the short term, these could grow at different rates, but overall, long-term projections, they should be the same, and that would result in a consistent dividend yield over time. And that's why personally, I like to use the historical dividend yield to help indicate when is a good buying opportunity. As we know, this tends to revert back to the mean. So whenever there's a spike in the current dividend yield, it's probably because the share price took a tumble while the earnings didn't really change any. And for the S&P 500, we can see that back in 2022, that was a great example of this. And since the price has been recovering and going back up so far in 2023, the yield has been reverting back to the mean. And whenever you don't see this pattern and the yield is actually, say, increasing over time, that's often a red flag. So Intel, unfortunately, is a great example of this. So their yield was skyrocketing. Investors were initially really liking this, but it wasn't sustainable. The earnings wasn't actually growing. They were just paying out more and more of those earnings. And eventually that is unsustainable. You have to cut the dividend, and we see the result of that here. So there you have it. Those are two major lessons I've learned so far in my investing career. The debate between growth and value is a lot more nuanced and complicated than it initially seems. It's not as simple as buying the line that goes up and to the right the most. And for us dividend investors, it's important to fully understand how the dividend yield works and reflects back on the company. Dividends are not some extra magical source of compounding. It's just part of the total return, and it tends to revert back to the mean. And for savvy investors, that could help you identify potential cheaper valuation periods. So I hope you guys enjoyed the video. If you did, leave a like before you go, and I'll see you guys in the next one.